So next up is a legislative update on the 8% law, which I just referred to without really explaining what we were talking about. And we have Emily Friedman from the Commission here, who's the Director of Housing and Human Services for the City of Providence. Bob Azar, if you could come to the table, Director of Planning, City of Providence, and Seth Zarin, the VP for Development of Armory Management Company. Now, we do have more people in the room than we are typically used to having. Usually it's the one. So I will say we don't take public comment at the Commission. However, if you have questions or anything you hear about the testimony, please do send it to me at rep.speakman at rilegislature.gov, and I will make sure that we get the answers if you don't hear the questions today. And there are several representatives in the room. Thank you for attending. Rep. Cruz, Rep. Morales, and I think I saw, yes, Rep. Sanchez here. So thank you for coming. Appreciate it. Okay, take it away. And we also do have a PowerPoint, which will be posted on the committee documents for those of you who are watching from afar. Thank you.
Good afternoon. Emily Friedman. I am the Director of Housing and Human Services for the City of Providence.
Red light on and pull it closer.
Good afternoon.
Oh, that's better. Thank you.
I'm Bob Azar. I'm the Deputy Planning Director for the City of Providence.
Good afternoon. My name is Seth Zarin. I'm Vice President for Development at Armory Management Company.
Thank you for welcoming us back this afternoon. As everyone in this commission is well aware, 8 Law is a very powerful tool in Rhode Island's toolbox to incentivize the development of low and moderate income housing and ensures that low-income rental housing units can operate sustainably in our state. However, as we know well and all have been collectively working on, there's a strong need for clarity on how the tool should be targeted, deployed, and applied to ensure predictability in development and project viability. As you may be aware, we previously presented legislation prior session. And learned some lessons, took some additional feedback, did some additional off-session engagement with the development community, financiers, and municipal assessors to take into account that feedback and make some targeted amendments. So through bill sponsors, we have introduced House Bill 5688 to make those targeted amendments to the existing 8 Law bill, with the goal of clarifying applicability and qualification for what we colloquially know as 8 Law, which is the preferential tax treatment for affordable housing. So we know that this is often litigated and that there remains a patchwork treatment of application across our state, which was confirmed when we recently reached out to tax assessors and again checked in on how they apply and utilize 8 Law, and also Rhode Island Housing has published a 2023 study about the applicability of 8 Law across our state to various developments. So right now, 8 Law enables qualified developments to receive a deeply discounted preferential tax treatment, so 8% of your gross rental revenue, in lieu of the standard commercial tax rate, provided that the development restricts either tenant incomes or the rents charged. Note, not both. So an amendment to the state law, we believe, is necessary to ensure uniformity of the application and that the law complies with the original legislative intent, which was to incentivize and ensure affordability for deed-restricted rental housing. So for the House bill, the initial package of amendments includes clarifying that 8 Law should apply to new construction. In reality, in many cases, it is being applied across municipalities to new construction, but it is actually only specifically for substantial rehab, according to the current language of the bill. So this seeks to clarify how to apportion the tax treatment appropriately to the residential square footage that meets the minimum affordability requirements. It will codify that both new construction and substantial rehab should qualify, and it removes any ambiguity with relation to applying that tax treatment to commercial square footage. Across our state, many assessors apply it to the entirety of the building and do not attribute it solely to the residential portion. So again, our goal here is to ensure clarity for municipal assessment across all 930 all 39 cities and towns, remove any unintended incentives, and ensure predictability for developers on how the tax treatment will be applied. One of the most well-known and challenging aspects of the existing legislation and the existing law is that it does not define affordable, and it does not define affordability thresholds that must be met to obtain the tax treatment. So the City of Providence, after much engagement, has identified recommended thresholds that we feel are appropriate to justify this sort of public good and public incentive. So this is proposed as at least 40% of rental dwelling units affordable to households at or below 80% AMI, or at least 30% of the rental development units affordable to households at or below 60% AMI. So also the need to ensure that both, when we talk about affordable housing, we mean that incomes and the rents that can be charged should both be restricted. And that really is seeking to align with the state definition of low and moderate income housing that already exists, not only in the work that we do on the Low Mod Housing Act, but also elsewhere in statute, and also aligns with other subsidy thresholds. So for example, low income housing tax credits. So again, the goal is to clarify the affordability definition and the thresholds that must be met to receive the benefit at minimum. There is also the challenge of how this applies to properties that may have been granted the tax treatment previously. For example, in the City of Providence, we have 618 properties as of last count who are receiving 8 law, hundreds of which are financed by Rhode Island Housing or the State of Rhode Island or the City of Providence itself. And so the goal is, of course, to create a provision where anything that was granted 8 law under the prior treatment by a tax assessor can retain that tax treatment. And that is really to ensure that projects that are operational, occupied, and that were underwritten with 8 law taxation remain viable and don't experience any unforeseen operating shocks that would place them potentially in jeopardy or create cost increases that would need to be passed along to tenants.
Thanks, Emily. Thank you, Madam Chair and members of the Commission for inviting us today. I'm going to talk about the Part B of this bill, which is relating to tax treatment for adaptive reuse. The General Assembly passed a zoning change last year that speaks to adaptive reuse and recognizes that adaptive reuse is an important tool to use for housing production, and it requires communities to allow for adaptive reuse for housing. What we have found in Providence through many years is that adaptive reuse can be a very powerful tool. It is a way of taking structures that were built for a particular kind of economy, and when that economy is no longer there, rather than take the building down and build new, adaptive reuse can further community goals of historic preservation and environmental sustainability and providing housing. And we have thousands of dwelling units in Providence that have benefited from our already relaxed zoning that allows for this sort of thing. Much of that housing was created through a combination of historic and federal tax credits. State and federal historic tax credits. The state credits, if they're available, there's just a small amount, and there's no new historic tax credits. So this would be a way of kind of creating a tax incentive for projects that can be very expensive to create. And I'll defer to Seth Zarin in a minute to talk a little bit more about that. So the way that this would work, just a little bit more background. You know, if we're going to get to the targets that the state is proposing, adaptive reuse is going to be one of the most important tools in the toolbox. And you know, just a little bit of data on the Providence side. we have perhaps 1,000 units under construction, but 3,000 in the pipeline. And, we're getting to the place where really zoning is not the major obstruction. It's other things. It's rising construction costs, lack of predictability in many cases over what's available from the tax stabilization standpoint. And obviously there's great demand for housing, and there's considerably less demand for commercial space. So this tool, we think, would be very helpful to advance that. Okay, I think we're going to turn it over to Seth to talk a little bit about the numbers.
Thanks, everyone. My name is Seth Zarin. I'm a partner and vice president for real estate development at Armory Management Company. Just to clarify, I'm here as a private citizen, not in any affiliation with any other organization that I might be involved with. Just be abundantly clear about that. When I first read the text of this bill, I was like, oh, this is great. We're going to finally resolve this 8-law fight that's been happening in the background for a while. And then I got to the second part, and I was like, wow. Now, I'm a real estate developer, and when most of you hear a real estate developer go, wow, you get a little concerned. And I get that, right? We don't always have the best reputation. But the reality is that we build houses, right? That is what we do. We like to build houses. And I can tell you that this provision would have a big impact. This is not a little impact. This is a big impact. And I'll tell you why. So, depending on who you count from, there's 15,000, 24,000, 50,000 housing units. We got to build a lot of houses in the state of Rhode Island, right? And if you add up the amount of capital that has to be deployed to build those houses, we are talking $10+ billion, a lot of money. And in order for that investment to happen, we need predictability, right? In order for us and for other people, including nonprofit developers, to raise money, there needs to be predictability. I can say, this is my tax rate, and this is what it's going to look like in the future years, because property taxes are our single biggest expense in operations. It's a big deal for us. We've had properties in the last few years that have increased their assessed value 25, 50, 100% year over year. And without corresponding rent increases or revenue increases. In some cases, we're sort of able to absorb this, but in a lot of cases, this is very painful to the operating budget, to the investor returns, to the bank financing, to the future of that asset as real estate, to the future of new investment. And as our largest investor said earlier this week, as we were talking about this and some other issues we've been having with our latest round of assessments, he says, it seems hard to justify investment in Providence without some sort of special deal or protection on taxes. And I would like to get away from the special deals. It's not good for us. It's not good for the city. It's not good for the politics of the city. It creates a lot of tension and a lot of complexity and a lot of, it's just not a good situation. The unpredictability is very high. The source of conflicts is really high. So I'd like to share a couple case studies. I did another one, but it wasn't in time to get in a presentation, so I'll just talk through that. So this is a building. This is an adaptive reuse project we finished in 2023. It's 31 Parade Street. It was actually the original home of Miriam Hospital on the west side of Providence, right on Dexter Training Ground. Originally built as 4 residential townhouses that had been converted to the hospital in the 20s, and then we brought it back to residential in the early 2020s. This project needed a lot of help. We got some tax credits, federal historic tax credits, and we had a tax stabilization agreement. This is one of the properties that has had its assessed value double in the last 2 years. Now, without our TSA, we would be in big trouble, right? And fortunately, we have a TSA, so we're not. We've got our tax situation with predictability. We're able to talk to our lender and to our investors and say, this is what the tax line is going to look like. This is what our income line is going to look like, and it works. It makes sense. Because otherwise, I wouldn't be talking about doing my next building because I'd be figuring this one out. And that is a real barrier to developers, right? If we and builders have to fight over the last project, we're not building the next project, right? We need to be able to move on with certainty from one to the next. This building was 12 2-bed, 2-bath apartments in Providence that we're able to build. I did run the numbers with the 8-law scenario as proposed, relative to our tax stabilization agreement and relative to no stabilized taxes on this project. And, I'll be honest, when I first saw the rate, I was like, wow, this is really good. Is this going to be too rich? And I looked at the numbers and I ran them, and I was like, no, actually, this is about on point. So I wasn't involved in any of the initial drafting. I wasn't involved in any of the initial financial modeling. I did my own model, and I wouldn't say it's exhaustive, but I was like, yeah, this seems about right. It's certainly an incentive. It improves yields on the property, but it does not turn it into some sort of magical home run. It just provides certainty and stability going forward. Let's go to the next slide. Which leads to the question, and I teach real estate development on the side sometimes, and I'm doing my very best to distill a very complex idea. So here goes. What's a building worth? All right. In commercial real estate, a building is worth its income. Every year, a building generates a certain amount of net operating income, and that is basically you take the income, the total income, the gross income, the rent, and you subtract the expenses, right? Taxes, insurance, utilities, maintenance, etc. And what you get out the other end is net operating income. This is before debt. Just the building, regardless of financing or capital, it's just what's the building generating income. So if I asked you a question, what would you pay me today if I told you I'd pay you $1,000 a year into the future? You'd pay me more than $1,000 because you're going to keep getting paid $1,000 every year into the future. But you probably wouldn't pay me $100,000 because that you're only going to get $1,000 back each. It's going to take 100 years to get your money back. So it's something in between there. In real estate, we talk about this concept of the capitalization rate. The value of the building, we take the NOI, that operating income flow, and we divide it by a market rate of return called the cap rate. It's usually between about 5% and 10%. It can be all over the place, but that's a pretty good range. So $1,000 of annual income, net operating income, would be between $20,000 of value today and $10,000 of value today. Now, when expenses go up, the value of the building goes down. Right? Because the value of the building is based on this income minus expenses. So when my expenses go up but my income doesn't, then the value of the building goes down. Right? If the value of the building goes down below the cost of construction, land, design, permits, financing, investor return, and developer's profit, the project either fails or it doesn't get built. Another way to think about it is if we assume a sort of middle market 7% cap rate, $1,000 increase in property taxes today reduces the value of the building by about $15,000 in property value. I want to just make one other point about this too, which isn't in the slides, which is that there's often a desire to figure out like, where's that magical break point where we can, we're not harming projects, but we're getting a little bit more. And I just think that's kind of the wrong way to think about it. You got to imagine there are like 100 projects out there in the world that you could do. And some are really profitable and some are money losers. And if you stacked them all up in a line, let's say today you could do 40 out of 100 of them. And the point of an incentive is to move that on the margins. So there's going to be the next 10 of those you'll be able to do. You're not going to be able to do all 100, but you'll be able to do 50 out of 100 instead of 40 out of 100. And that increases the number of homes that are getting built, the number of spaces being renovated. So it's on the margin, right? There are going to be projects that still work without this law. If this law gets passed, there's going to be a bunch of projects that work with it, but not without it. And there's going to be a bunch of projects that don't work anyway, even with this law, right? So we're just moving the window over and getting more. Let's go to the next one. So I just want to make sort of one kind of caveat. I am not at all opposed to this bill. I think this bill is a good idea. I appreciate that it's controversial and there's a lot of concerns, and I'm going to address one of those concerns in a second here. If I had one sort of reservation about the design here, is that it only applies to rehab of the existing structure. And generally speaking, I agree with that. Our firm does a lot of historic rehab. We expect to keep doing historic rehab. I think this bill particularly is in mind of downtown office towers, right, which make a ton of sense for residential conversion. But there are going to be some circumstances on the margin, on the edge, where there's going to be some weird outcomes. And this is one example of that from something that we're working on today, 45 Central Street in Providence. We're working on a approximately 19-unit apartment building that would replace an existing one-story commercial structure. I've got the math on the board here. This building doesn't quite work yet today. We're working to see if we can make the numbers work and make it pencil and make the project happen. The one on the right would be just, what if we left the building there and we just turned the whole thing into residential units? Just without doing anything to it. And we could, make it prettier. You add some windows, add some skylights, maybe carve out the middle for some more light. But it would be the same footprint. but we would qualify under this law under the 8% threshold because we're working inside the existing building footprint. And it works. You know, at the first order approximation in like an afternoon's worth of math, that project works today. The other project, you know, which we'd rather do, doesn't work yet. So I don't know that this is a reason not to do it, but I just want to raise that as an area for future work, either this round or in future years, because I do think we do want to replace our strip malls with apartment buildings and mixed-use apartment buildings. We don't want to just say, hey, we'll move out the Papagenos and move in 2 studios. Yes, it's housing, but I don't know that that's like the best outcome. I just want to, because I didn't have a chance to do this math. In my third case study, I didn't write. I took an example of a downtown office building that I know has high vacancy. I won't tell you which one. But I looked at it, and that building today generates, well, I can tell you that. I'll tell you which one. It's all public information. It's the Turk's Head building, 76 Westminster Street. So its assessment was just marked down from 12.2 million to 9.3 million in the 2025 update because it's an office building in downtown Providence with high vacancy. So it lost 24% of its assessed value. That's $104,000 of taxes at our current tax rate. If it were redeveloped as residential, the building, so it's about 180,000 square feet. You know, you assume you can't use it all. It's about 180 apartments when it's all done, depending on your assumptions of rent. But I made I think a reasonable one. You get about $7.8 million in gross revenue. At 8%, it generates $624,000 a year of tax revenue. So it would generate twice as much tax revenue, almost twice as much tax revenue under the 8 law scenario as it does in 2025. Because the building they're going to invest $81 million in it. It's going to be a much more valuable building to convert it to residential than it is as a half-empty office building. And so it will still pay more taxes than the other building. Now, will there be some cases where the conversion might pay less taxes than what's there now? I mean, maybe. Certainly on the margin, there'll be some project like that. But my guess is that any conversions under this scenario will be revenue positive for the city. I have to guess, you know, not having studied every parcel, but on average. And that project, when I ran the numbers, is sort of on the bubble. It's right around the edge of working. So it probably would happen. If interest rates come down a little bit, it would go in that scenario. And the math behind all this, I can explain, but I don't want to try to do it in here. So anyway, I'm happy to follow up with anyone who wants to spend time in a pro forma looking at stuff. And anyway, I hope that's helpful. I don't pretend to have gospel truth. I'm just one guy who's done a little bit of math in the last week, trying to think through for myself how this might play out. Thank you.
Thank you, Seth. So to conclude, and then of course open it up for questions, our goal here is to amend the existing legislation, which will allow for greater predictability in determining the viability of development for affordable housing and adaptive reuse projects. This legislation will close loopholes of which we are all very aware that have allowed the 8 law to be used in a way that is inconsistent with the intention of the original law. And then an additional goal will be to create a pathway using the 8 law model for new development to occur through adaptive reuse and for the ability for new construction to be considered for the 8 law treatment. So again, we appreciate the opportunity to speak to you all today and look forward to answering any questions you might have.
Thank you very much, very helpful. But before I go to the other members of the commission, Seth, I have one question about your 31 Parade Street
Yes.
development. It has a TSA.
Mm-hmm.
What body or person granted that TSA?
So it was the Providence City Council.
The city council did.
Mm-hmm.
And if it were an 8 law tax incentive, who would grant that?
As proposed under the current proposal,
Yes.
what their city's proposing, it would be, I believe, by the assessor at certificate of occupancy.
Is the assessor elected in the city of Providence?
No, it's not an elected position.
Thank you. Amy.
Not a question, but I just want to offer a clarification, not on the proposal, but on the underlying statute. Emily, when you were giving the description, you mentioned the 8% rate is a deeply discounted tax rate. I'd just like to clarify for folks that under Rhode Island housing laws, many folks are familiar, properties are taxed at their full and fair tax value. And the genesis of the statute is that there was a period of time when affordable developments were being taxed sort of like they were market rate properties, which they are not, and they are not able to raise their rents to the levels that might in a market rate property be considered appropriate. So the 8% as established was intended to represent in general terms for on a statewide basis the full and fair cash value of a deed restricted property. So I just wanted to clarify that because I know some people feel like they're not sort of paying their fair share or whatever, but in reality the 8% is intended to, and I believe it largely does reflect that deed restricted value of those properties. Thank you.
Thank you. Other questions? Yes, Vice Chair Toronto.
Thank you. And thank you for presenting today. 31 Parade Street, it seems like a beautiful property. Do you happen to have information as to what rents are, what the average rent is for one of the units there?
It varies depending on the unit type.
Sure, but any unit type, can you give me an example?
It ranges from the mid 2000s to mid 3s.
And then, thank you. And then I have a follow-up.
Sorry, could I just follow up on that a little bit? I know rents sound high. I can tell you that we have tenants in that building that make hundreds of thousands of dollars a year. They can choose wherever they want to live in Providence. We are not even close to 30% of their income. I can't make the people with a lot of money go away, but I can give them places to live so they're not competing with existing residents, if that makes sense.
Okay. Separate question. Is it true that there are residential properties right now that are currently receiving the 8 law benefit for non-affordable units?
That's correct.
And under this legislation, it's still intended that they would continue receiving that.
We, after reviewing the portfolio here and then across the state, it is very important that if properties were underwritten and occupied and financed with this tax treatment in place, that there needs to be some type of grandfather provision. Otherwise, we would fully expect that those operating shocks would either need to be absorbed by tenants or by lenders. And for many of us who are public lenders, that is a very scary concept.
Yeah. The thought that comes to my mind is there some sort of process in which maybe they don't absorb that full impact immediately, but over a span of a certain amount of time, they can come into conformity with everyone else so that they don't seem to be getting this benefit that was intended to be for affordable housing and wasn't implemented in that way. So I would encourage everyone to think about, rather than just ignoring it and just letting it be, finding ways for us to bring them along, even if it may take longer, even if it is a lengthier process. I think it's something that is important and shouldn't just be moved on from.
That's excellent feedback. And for most projects, we know they have life cycles, so they will work through their mortgages, they will work through their deed restrictions, and I think that will be a potential opportunity where we could look at that sort of phased approach to start transitioning them off of the treatment, and then we would have this new piece of legislation that would apply and be the new treatment for which they would need to qualify. Thank you.
And I should mention, you mentioned the word feedback. This bill is in the proposal stage. It's been heard in the House committee, not yet in the Senate. So this brain trust, which I think we were referred to earlier, not me, I'm excluded from the brain trust, but if anyone here has feedback about the bill, I think now is really a really good time to introduce that feedback into the conversation. Annette?
Hi, this is less of a question and more of a thought process. When I look at the affordability thresholds, which I am totally in favor of, and I know that most of the comprehensive permits that come through are for sale units, and they're at 120%. But I know that over the last several years, we've tried to build in some incentives to use the low and moderate income housing bill to build more rental. And I'm just off the top of my head, I'm trying to remember how your affordability thresholds really fall in line with that. I seem to think it's like if 50% of the units are built below 60%. I don't remember exactly, but I guess my thought would be, could these two things be brought in line so that if we do have a comprehensive permit and if a developer is perhaps considering doing rental, could we make sure that this provision does not exceed what they are able to be doing? Thank you.
Thank you. I will note that there was a 2022, I believe, piece of legislation that was approved by General Assembly regarding comp permits, and this threshold is directly tied to that, meant to align as carefully as possible.
Other questions? Yes.
I want to make sure I'm understanding what you talked about when you did the slide on Central Street. So basically, the way that this bill is, I'm sorry. Basically, what I'm understanding is the way this bill is written, that you can use it for that, but you have to stay completely within the existing building. You can't go up, you can't go sideways. You just got to stay. Is that what the problem is here?
Well,
And I got it. I'll admit, I haven't read the bill, so.
my reading of the legislation, and you guys can correct me if I'm wrong, Bob, is that it applies only to the existing building area. So an addition doesn't knock you out. It just means you can only apply the exemption to the original building area.
Okay. But my understanding is that without that new part and the other stuff, if this was a vacant lot, you could build as high as is allowed by zoning and as wide as is allowed by zoning, and
I mean, you could do that
still
on this
qualify.
lot too. You just wouldn't get any benefit unless you were doing the high percentage of income restricted.
So, but even if you're doing high percentage with this, you still can't do it.
No, you could. There's sort of two different tracks, as I understand it, right?
Okay.
So there's track one, if you are 30% or 80% or 40% or 30 at 60, you just get 8%. That's what Amy was saying, right?
Okay.
The second track is really focusing on adaptive reuse. And my understanding is part of the challenges is when people have been using 8 law, perhaps not as intended, to do adaptive reuse of commercial buildings. So we're trying to regularize that process.
Okay.
Maybe I'm speaking out of school here. I don't do that.
Okay. All right. And, okay. So I think I was misunderstanding it. Good. Okay. Thank you.
Just wanted to follow up on the next question. I think that the statutory reference that you're talking about is 4553 3.1. So that's, it's a different thing. It's what we count as low and moderate income housing. So under the statute, if it's a comp permit or rental development, comprehensive permit development, and at least 30% of the units are deed restricted at 60% of AMI, or at least 50% of the units are deed restricted at 80% of AMI, then all of the units in that development count as low and moderate income housing. So it's a little different. It's not about taxation. It's about what counts as LMIH, but I think that's what you were referring to.
Because
I know that some of the municipalities like to try to reference that to encourage rental as opposed to for sale properties. Katie.
Thank you, Chair. Thank you to all of you for presenting, and just for the record, the Housing Network supports this legislation. We know there was a robust engagement process with our membership in dialogue with the city. But I did have a question about the adaptive reuse component, which has come up. Chairwoman raised it at the beginning of the meeting, and I did watch this come up in the committee hearing as well. But are there any affordability requirements or inclusionary requirements on the adaptive reuse component? And if not, can you expand on sort of the thinking behind that?
I can start, and then maybe the others can amplify this. So the answer is no. It doesn't mean that you couldn't have affordable units, but you could get this tax treatment without those affordable units. And the intention is to help defray the costs of doing adaptive reuse. And if we were to then put a condition on it that the units had to be affordable, I think if you ran the numbers, you would find that requirement outweighs the benefit that you're providing through the tax treatment.
We also fully anticipate, because of how expensive and challenging adaptive reuse is in buildings that are largely vacant, functionally obsolescent, we expect that there will be layered incentives. So most of these projects, again, this is a tax treatment that is providing some level of discount, but it is not enough that's going to offset those increased costs of construction, remediation, complete replacement of obsolescent systems. And so we do still expect that there will be layered low-income housing tax credits, historic tax credits, EPA brownfields, and so a number of things that will still make inclusion of affordable housing probably a very realistic part of a developer's decision-making process when determining whether or not conversion is possible. I think the tax treatment will help one issue in the net operating income challenge of a pro forma for a conversion project, but there are many others in that equation that will require other layered subsidies to address.
I guess I'll just weigh in and say I agree. That sounds pretty accurate. Again, I think it helps to think marginally, right? So if there's 100 projects and we get 10 new projects because of this bill, but then we add on an inclusionary requirement, well, we get less than 10 more projects. So it's some projects will take advantage of it, it'll work, but you'll get less, right? And I think one of the challenges with inclusionary zoning is that you're only talking about 10 or 20% of a bigger number. So what the bigger number is matters a lot. And if you're getting 10% of nothing, you still get nothing. So I want to be really careful to. I mean, I see the appeal. We love doing mixed income buildings. We've done LIHTC projects. We do home funds projects. We also do full market rate projects. They're all good. But the stack has to work. The numbers have to make sense. And I'm not taking a side in that. The impact will be that it will be less effective as an incentive.
Dave.
Thank you for the presentation. I have a couple of quick questions. I want to preface that by saying I am on the City Plan Commission in Providence, and one thing that occupies a great deal of our time is asking our applicants where we can get more affordable housing built. I'm speaking the first half of this law, new construction and ground up. We haven't spent, in my opinion, enough time on that here in this hearing, but specifically in the areas where we need the affordable housing at the east side, we've asked many developers and are exploring, and Bob will jump in if I say the wrong thing, which is likely, so he will correct me. At the end of the day, do you think this will get more affordable housing built in the city of Providence? That's the question. I mean, big level picture. Is this going to incentivize us to build more affordable housing, and can we get there? As with this tool, will it be helpful? With all the other things we have to do, obviously, the planning and zoning.
Yes, I think, bottom line, absolutely, because it's the provision, certainly the provisions for 8 law are so much clearer than they have been that I think more projects will qualify than had previously been considered to qualify by various municipalities. So right off the bat, yes. And then with respect to the adaptive reuse, one thing that is possible is that given communities might have an inclusionary zoning policy, and if that's the case, the adaptive reuse would produce affordable units. In Providence, I think every community is different, every neighborhood's different. In Providence, inclusionary zoning, we have done some work around this, and requiring affordable units without some kind of layering of subsidies just doesn't pencil in Providence based on all the discussions we've been having. And so we just need to be careful about tailoring our incentives and disincentives in such a way that we actually get housing built. Because even if we have great incentives, if we put too many conditions on those, then the developers just won't build in the community.
Yep.
needs and desires, and this law alone still requires planning, zoning, community input, and all the other things necessary for development. But from what I see here, this law will help get more housing built and more affordable housing built. Is that what we can take away here? This is producing more housing, and it will not cost the city any money. Is that correct? Am I understanding that correctly?
That is correct, and based on the way when we did a survey of assessors across the state, based on the way some of them are currently applying 8 law in probably a more generous way than I think was the legislative intent, we expect that this will be revenue generating for a number of communities across Rhode Island, as well as to generate substantial amounts of affordable housing.
Thank you.
So I would love to see the data that indicate that it's revenue generating. That's great, because I read articles about property owners in Providence who are going to have significant increases in their property taxes. So if you could talk a little bit about how we justify giving tax incentives to developers for people who don't live in Providence yet, and at the same time raise the property taxes on people who are living there. How do we justify that? And then the second question is about the conversion of mills. In particular, I've received a lot of calls. In some of the mills, we have artists living, we have small businesses, we have live workspaces, we have small businesses. How do we, this came up at the committee hearing when we heard the bill, how do we preserve those really important assets in the city as well? Again, a private owner comes in and kicks everyone out and uses this law to help them. So if you could answer both what about the other taxpayers in Providence, and what do we think about mill conversions that lose some valuable cultural
Sure.
assets?
I'll start with the second question first. We have heard and continue to hear feedback that there is still sort of a separate and parallel issue that needs to be explored, which is the issue of community commercial. So these are, for example, our partners at One Neighborhood Builders do a lot of projects where you are developing mixed-use properties, which as a city, we love infill development. We want mixed-use properties. Choosing to use those ground floor retail spaces for nonprofits, but are still taxed at full commercial rate. And so we have heard that community commercial is a challenge. We have also heard feedback that there needs to be a conversation about the preservation of commercial spaces that are used for studios, for artists. And so we feel that that is parallel and separate to a housing bill, but is certainly something that needs to be addressed via either a tax commission or through further study and potential future legislation.
I'll just add from the other side of that, which is I'm one of those landlords that has a lot of community commercial space in our portfolio, and we rent to a lot of nonprofits. We rent to a free clinic. We have a bunch of artist studio space, and yeah, the tax rate is 3 times that of the owner-occupied residential rate.
And what about the folks in the rest of the city who are facing higher property taxes?
So as the mayor touched upon in his initial testimony last week, one of our major concerns that we are seeing, and many in cities across the country are seeing this, is that as your commercial vacancy goes down and the valuations go down, that is a loss of revenue that hypothetically will very likely need to be picked up by other taxpayers. And so our goal with this piece of legislation is to proactively combat that and ensure that we are converting properties that are likely losing value before we have a crisis where that tax burden needs to be passed along to other taxpayers. So that is a particular challenge, that when you are not able to maximize what you're charging on commercial tax rates, then that is obviously being passed along to via the residential rate.
Yeah, and for those of us who are electeds, that's a hard argument to make. My tax bill's going up 20%, and Seth, the developer, is getting this tax break for something that hasn't even happened yet. No one's living there because it hasn't happened, and that's a hard argument to make when an elected official faces their constituents. I, by the way, am not from Providence. I am the sponsor of this bill because I think it's really important to open a conversation about the 8 law, but I have a hard time imagining how my colleagues from Providence will go to their constituents and the council members too and explain how that all works. Because what you said was a technical explanation. And you know, when Seth, with whom I work very, very productively and constructively, says his apartments are $2,500, $3,000, there, again, we hear work on affordable housing. I'm not hearing, except for Part A, I'm not hearing how this helps increase the stock of affordable housing. Except the general principle that if you build more housing, there'll be this trickle-down effect, which was a term I don't think I could use, but it can help us make sense of this.
Yeah, no, I appreciate that. I personally live in Providence, and my house increased in value 50% this last time, so I'm not looking forward to my tax increase either. And as a commercial property owner in Providence, we have a lot of property in Providence that's seeing huge increases. It has no protection. And so I'm really bummed about that. And yet I'm here because I believe that building more and increasing the tax base of the city is like the only way out of that problem. When I run the numbers, and I'm happy to share that, like it looks like these buildings after rehab pay more taxes than they do before rehab. So while the rate is gonna be lower, there's more revenue. And I appreciate that that's a hard conversation to have, but I'm looking at a building in downtown Providence that's paying for two fewer school teachers next year because it lost $100,000 of tax income. So yeah, it's tricky. And I think to the larger question of what does market rate supply do for affordable housing? Sometimes we talk about cars, right? The average sale price of a new car in the United States last year was like almost $50,000, which to me sounds crazy. Most of us can't afford a new car. Most of us buy used cars. We drive used cars. I also can't afford a new car like that. Most of us also live in used homes, right? Because new homes are really expensive to build. And part of the way we create supply is by adding supply everywhere. Because the people who move into those new homes at whatever price point, and we have homes at much cheaper price points, we also do LIHTC projects, we do a lot of different stuff. They leave another home, right? And then someone else is going to move into that home, and then that person's going to leave another home. And there's this chain of moves, and the data is actually very clear that chain of moves very quickly affects all over the state and all different kinds of income brackets and all kinds of different zip codes. Because it opens up housing opportunities and it creates competition so that we all have to work harder to get you to come live in our house, in our apartment building. So I don't know if that answers your question. I agree. It's not an easy conversation to have because I also am not looking forward to my tax bill going up next year.
Well, and when we read about the folks that Haley represents, the folks who do not have a home, one of the explanations for why the numbers have spiked is just what you said, that folks who could afford more are pushing people out, and on down it goes, and then you get folks at the bottom having no place to live.
Well,
right?
It's sort of like musical chairs, right? Everyone knows the game of musical chairs, right? A bunch of kids and a bunch of chairs, but there's not enough chairs to go around. So the fastest kids get chairs, and whoever's unlucky doesn't get a chair. Well, the easy way out of that is to add more chairs. The fast kid's still going to get the chair they want, but you're not going to run out of chairs. Everyone gets a seat.
I hope you're right. Leader.
Thank you, Madam Chair. 8 law notwithstanding, let's completely take this off the table. Would taxes still go up in Providence?
Yes.
Okay, so if these commercial dwellings, which have low occupancy rates, continue to see lower and lower occupancy rates until we had vacant buildings, would that disincentivize businesses and commercial spaces from continuing to rent or coming into rent?
Potentially?
The market and history indicates yes, it would.
Yes.
That would then, if I'm not mistaken, lead to blighted areas, which would then decrease the property values of everyone there around.
Correct.
So then an incentive like this to get private investors to take their own sacred fortune and make a risky gamble, which is what they're doing, to build housing, be it high level for people who make $500,000 a year, or be it affordable, is an incentive to keep not just Providence, but any city vibrant and alive, is it not?
Absolutely. Growing rates of vacancy are not good for the tax base, are likely to, again, those costs get passed on to other existing taxpayers, as we know. So to Seth's point, broadening our tax base and ensuring that tax base is as robust and high value as possible is incredibly important to avoid those costs being passed along to existing. We know we have an aging population in Providence and elsewhere in our state that are continuing to see increased tax bills as the supply, as our housing stock continues to increase in value while commercial values are dropping.
So as a legislator who is often faced with difficult, challenging questions from constituents, that's precisely how I would explain it to them. We either incentivize growth or we die on the vine, and everyone loses. It's our job to have those difficult conversations, and this does appear to be a way to get people who are in the private industry and who have no obligation whatsoever to spend money in development to do so. And I think that's really what we're all trying to do here. So I appreciate this proposal. Thank you.
Now,
Great job. And I just wanted to say I'm really on board with the extension of this to the planned redevelopment stuff. As somebody who goes around the state to all 39 cities and towns, people don't want to think about the new places. They like, things that are there already. So adaptive reuse, we hear about it all the time. The planned redevelopment, I think people are starting to get their heads around. So, and given where we want to grow, those are the areas along our commercial transit corridors already. So I think this would be an easier pill for neighborhoods to swallow as well. So thank you.
so I have a question. This strikes me as it's really two bills. As Amy explained, the 8 law as it applies to projects that include significant numbers of affordable units exists so that those landlords can charge below market rents that folks can afford. And they need the tax relief in order to afford, to make their projects work when they're charging rents that don't pay their costs. That's one use of this law. The other use, Part B, the famous Part B, is about incentivizing folks like Seth to build at any price point, right, for any type of tenant. Can you help me understand why they're in the same bill as opposed to two separate bills? If you didn't write the bill, that's okay. You can just.
I didn't write the bill. I don't know that I have a really good answer for you, but I think it relates to the fact that they're both using similar tax treatment. That the adaptive reuse standard follows the 8% rule for the first 15 years and then ratchets it up a bit. So it's I think probably because of the similar tax treatment.
Mm-hmm. And is it then I'm asking questions on behalf of a whole bunch of folks who have contacted me over the past week and especially this morning, a lot of time on the phone. What would happen if the recommendation came to carve out 10%, say, of these adaptive reuse projects to be affordable at 80%, something like that? Would these projects no longer pencil out, as I've learned to say?
I don't know. Happy to investigate that. There may be smarter people than me to work on that question. I can tell you that you'd get less, but if that's what it needs to happen and we still get more overall units, it might be worth considering, but I don't know. You'd get less.
I mean, we've given lots of density bonuses over the years to encourage people to have a chunk of their units at affordable levels. It seems to me, why not tie these? And again, that's the job of this commission, is to try to figure out ways to get more what is in the legal parlance affordable units. So I feel I want to tie this conversation to our mission as a commission here. And I know, Seth, you're a developer, not a member of the city Providence government. So, yeah, thank you.
I just wanted to add and circle back to an earlier point that was made that we do expect elsewhere in the state that there are inclusionary zoning policies that will already be layered here that will mandate some level of affordable housing on top of this if they choose to use this adaptive reuse treatment. In Providence, I think one of the particular challenges with landing on an appropriate threshold for this component is it is already so challenging to get adaptive reuse for office towers, vacant nursing homes and hospitals to pencil out in the urban core that adding that additional layer without being really, really careful about having an appropriate threshold effectively would, render it still not an effective tool. And so we are erring on the side of being cautious that we don't feel like a minimum threshold is currently appropriate for Providence, but we'll continue to take that back and evaluate.
Okay, thank you. Other questions? I'm asking all the questions this time.
Can I just add something about minimum thresholds and affordable units? 10% is a percentage, but homes only come in homes or not homes. So one of the things that happens is as the building size gets smaller, you have to figure out how you're going to treat fractional units. So if I have a 4-unit building and there's a 10% requirement, is there no requirement or one requirement? In which case it's a 25% requirement. It matters less when you've got a 200-unit skyscraper being renovated, but like at the smaller project scale, you got to choose how that gets calculated, and it matters a ton as to whether it has any impact or active harm potentially.
Thank you. Let me ask one more thing. This is a broader question, and maybe for Seth. So we've heard over the years lots of explanations for why, the speaker came in with his housing agenda very first, production. How do we get more units built? And we've heard lots of explanations for why units aren't built. First, it's rigid zoning. So we've done a lot over the past couple of years to loosen up zoning, to the dismay of many cities and towns. We've also heard that it's insurance. We're thinking about how do you do that, right? So, and now we hear, or it's construction costs, or it's labor costs, and now we hear that it's taxes that are inhibiting development. So when do we get to the magic place where we've got all the pieces in place, and now the buildings will come, and the rents will drop, and when are we going to get to magic land?
I think this is why we're all so incredibly busy and why this is such a enduring challenge here in Rhode Island is every item in a project pro forma is extremely expensive in the state of Rhode Island, and compared to the New England metro region, we're paying Boston construction costs, we're paying the same interest rates, we're paying higher taxes, but we're charging lower rents, and potentially paying higher insurance. So every element in a project pro forma right now is a challenge for a developer, and perhaps developers on the commission can speak to that, but there's not a single line item I can think of in a project pro forma that is not currently something that needs to be worked on.
Wow, that was not optimistic.
I would agree with
Sorry.
that. Yeah, this is like, if I can be a little philosophical for a moment, like there will always be the next problem, right? Any problem you remove, you will then find the next thing that limits you, right? And that's what happens. We remove one line and there's the next one, and there's the next one. And I don't know, is this just Sisyphus pushing the boulder up the hill? I don't think so, because we can see examples internationally and elsewhere in the United States where if you build enough homes, you actually do see rents decrease, and you see sale prices decrease, and you'll even see panicked news articles about how terrible it is as the real estate market's crashing. Well, that's the flip side of affordability, and I'm not excited about that. We own and operate real estate, but I'd rather make money building the homes than just watching them appreciate. And so I think there isn't some magic threshold, but I would suggest that the housing markets are slow, right? That 31 Parade Street project took 4 or 5 years, partially because of COVID, to actually get done. It was an old nursing home, actually, that we converted. It was very expensive. We had to rebuild basically half the structure inside the building. And we got to the other side. But that's, from project start to finish, project conception, you have to believe that it's possible that it will work in 4 or 5 years before you even start. And so right now we have begun to set things in motion, I think, as a state that are seeds planted in the garden, and they are going to take years and decades of careful tending before the harvest will come in. And I wish there was a faster way to get there, but I just don't know that there is. You can see that that Rhode Island has been building for a couple decades now, like 1 home per 1,000 people per year, right? Which is off and on the lowest rate of home production in the country per capita, less than Alaska. Like Alaska builds more homes per person than Rhode Island does. The national average is about 4.5, so about 4 times as much. That's between Nebraska and Washington State last year. The fast-growing states, that's not even the fast-growing states, they're building 9 homes per 1,000 people. That's like the Floridas and North Carolinas of the world. So, like, we can fix the zoning, which you have to do, and then you can fix the operating costs, which is insurance and taxes. You can fix construction supply chain, which is our challenge. You can fix the labor market. We need a lot more people in the trades and building. You got to make land more available. You got to make it easier to subdivide lots to make land available for new homes. But all of everything matters. There's an easier way to put it. We got a long way to go.
Okay. Well, we've been at this for a long time and everything still matters. Okay, any other questions, comments, issues you want to raise? Okay. Well, where are we? Oh, good. We are almost done. So thank you very much for your presentations and for your answers. And again, for folks who've been listening, if you have other questions that you'd like to get answers to, please send them to me and I'll make sure that we get answers for you.